SpaceX erased more than $1 trillion from its peak, but rockets kept flying. Starlink kept growing. Here's the verdict: the market isn't pricing an operating collapse. It's removing the IPO scarcity premium and separating three very different businesses. If you're thinking about buying after the crash, that distinction is everything. A cheaper stock can still be expensive when the original price was set by a small tradable slice and a very large collection of future promises. Start with the price. SpaceX sold IPO shares at $135 in June. The first trade was around $150. The stock reached roughly $168 that day and closed just under $161, giving the company a valuation near $2.1 trillion. Then it climbed as high as $225.64. By our July 29th snapshot, it was $111.91 below the IPO price and less than half the peak. More than $1 trillion of headline value disappeared. Same rockets, same satellites, very different price. So what broke? If you look only at the launch business, you'll miss it. First, the IPO math. SpaceX offered about 639 million shares, including the over-allotment option. That sounds enormous, but the valuation attached to every share in the company was set by the price of the relatively small slice people could actually trade. You can see the distortion in one simple fact. Think of a packed auction with only a few tickets available. The winning bid tells you what the last ticket costs. It doesn't prove every ticket could be sold at that price. That scarcity matters because investors weren't buying only today's earnings. They were paying in advance for Starlink's global expansion, Starship, launch dominance, XAI, and even more speculative ideas like orbital data centers. One stock, several moonshots, almost no room for disappointment. Now the market is doing something it should have done earlier. It's taking SpaceX apart. The first piece is connectivity, mainly Starlink. Its revenue rose from $3.9 billion in 2023 to $11.4 billion in 2025. Segment-adjusted EBITDA climbed from $1.6 billion to $7.2 billion. Put simply, revenue nearly tripled while this measure of operating profit grew more than fourfold. That's not a dying business. It's the strongest argument that the sell-off has gone too far. But adjusted EBITDA isn't free cash flow, and Starlink can't carry any valuation at any price. By March, SpaceX reported 10.3 million Starlink subscribers across 164 markets, supported by more than 9,600 satellites. More users, more countries, but not necessarily more revenue from every new user. As Starlink expands into lower-income markets, average revenue per user can fall even while subscriber growth stays strong. If you're watching only the customer count, you'll miss that trade-off. Growth is real, the economics still need watching. The second piece is the space business. Revenue moved from $3.6 billion in 2023 to $4.1 billion in 2025. But segment-adjusted EBITDA fell from $1 billion to $700 million, partly as Starship research and development increased. More ambition, less near-term profit. Again, that doesn't mean the rocket moat vanished. Reliable launch capacity is scarce, and SpaceX remains extraordinarily difficult to replace. It means the moat is funding a very expensive future. Then there's XAI. This is where the valuation gets uncomfortable. The AI segment produced a $6.4 billion GAAP operating loss in 2025 and another $2.5 billion loss in the first quarter of 2026. For every $100 of AI segment revenue last year, the segment lost roughly $200 at the operating line. That's the problem. If you're betting on a rebound, this is the bill the profitable businesses must cover. XAI may become valuable, but today it's consuming capital inside a company already spending heavily on rockets, satellites, and infrastructure. You've probably seen the claim that the market now values XAI at zero. That's not an observed fact. It's the leftover answer in a sum-of-the-parts model. Here's how that works. An analyst assigns a large value to Starlink, another value to launch, then subtracts debt and other claims from the company's market value. Whatever remains gets labeled XAI. If the first two estimates are high enough, the residual can approach zero. Change those assumptions and XAI's implied value changes too. So XAI is worth zero makes a sharp headline. What it really means is that investors may no longer be willing to pay twice, once for Starlink's growth and again for every uncertain AI promise. That brings us to the next pressure point. Supply after the first results and the relevant lockup conditions, more existing shares may become eligible for sale. Eligible doesn't mean sold. Employees and early investors may hold. Some may face restrictions. The dates and conditions can change. Scarcity supported this stock. So even the possibility of more supply can change the price buyers are willing to pay. Before the IPO, the question was, how do I get shares? After more shares become tradable, the question becomes, what price makes me want them? We've seen that shift before. After Facebook's 2012 IPO, hundreds of millions of previously restricted shares became eligible for sale in the first lockup release. The stock fell. When Uber's lockup expired in 2019, the stock dropped about 3% on what was then its busiest trading day. But here's the part that usually gets cut from the story. A later, larger Facebook lockup expiration coincided with the stock rising. Unlocks create supply conditions. They don't write the ending. Company results, expectations, early holder behavior, and the price investors already anticipated still matter. That's the historical lesson for SpaceX. Don't confuse can sell with will sell, and don't assume a larger float is entirely bad. More tradable shares can reduce the scarcity distortion, deepen the market, and eventually make the stock less volatile. Painful repricing now can produce healthier price discovery later. So is SpaceX finally cheap? I don't think the falling share price answers that question. The company generated $18.7 billion of revenue in 2025, while capital expenditure reached $20.7 billion, and the company recorded a $4.9 billion net loss. In the first quarter of 2026 alone, the net loss was another $4.3 billion. The business is growing. It's also consuming extraordinary amounts of money. That can work when the return is extraordinary too. But you shouldn't value a capital-hungry business by subscriber growth, launch videos, or a lower share price alone. My judgment is simple. The crash doesn't prove SpaceX is broken. It proves the IPO price treated too many uncertain outcomes as if they'd already arrived. Starlink looks like a real fast-growing business. Launch still has a serious moat. XAI remains an expensive option on the future. And a small public float made the whole package look more valuable than a deeper market may be willing to support. If you're deciding what happens next, watch two things. First, watch where the cash comes from and where it goes. Connectivity profit against AI losses, Starship spending, and total capital expenditure. Second, watch actual selling after shares become eligible, not the eligible share count by itself. If profit expands faster than the spending burden, today's drop may look like the market overreacted. If new supply arrives while AI and Starship keep absorbing cash, the stock can fall further without a single rocket failure. That's the real lesson. Great company, powerful moat. Bad IPO math can still hurt you. This isn't individualized investment advice. It's the valuation risk hiding behind one of the strongest operating stories in the market.